Hi, and welcome to this video on adverse selection, which is an important concept that you need to know to pass your life and health exam. We have a lot of other great content too on lifehealthexamcoach.com. My name is Chris. I'm your life health exam coach, and I'm excited about jumping into this next topic. It is very important for you to understand adverse selection as an insurance agent and understand what you need to know to pass your exam. So let's dive in. You guys remember, from your studying so far, that insurance is what we call a transfer of risk, right? We're paying an insurance company in order to take on some of the risks so they cover it instead of us. So mainly what you're covering is the risk of financial loss, and that could be the loss of life. For that risk, we get life insurance. For loss of health, we get health insurance. So, life insurance is the transfer of risk, the financial risk that occurs as the result of a death. And health insurance is transferring the risk that occurs, the financial risk that occurs when we become sick. And so, those are important concepts to start to base what we're going to talk about in adverse selection. So also another concept in insurance that we've talked about in other training is a risk pool. Remember when an insurance company is taking on risk, they look at or consider that risk in terms of a whole pool of insured, not just one individual, but they have a whole pool of insured. That enables them to come up with all the calculations they need to make sure that they can cover their costs, be profitable, be able to cover those risks that they're agreeing to in the policies that they sign up. So in that risk pool, it's really important for the insurance company that there's a balance of health and sickness in that pool of insured persons. So it's never probably going to be exactly 50-50 like you see in this diagram, but the insurance company's goal is to make sure at least that you have, preferably more health than sickness in any given pool of insured. So if you have a situation like this where you have people, more people who are sick in the pool of insured, of course, that can become costly for the insurance company. So it's important as you start your study and start preparing to become an agent for you to understand from the insurance company's perspective, what are they trying to achieve? What do they need to, in order to maintain profitability and to be able to cover the risks that they're taking on by covering people for loss of life or covering for loss of health in the health insurance side. So I just want to do that little bit of review about risk pools for us to understand as a background, what is adverse selection? So this is an insurance term. It means that those who are at higher risk, they're adverse, are more likely to seek or select insurance. So when we think about adverse here, again, it's important to kind of put on your insurance company hat and think adverse means from the perspective of the insurance companies, because they're the ones that are going to be taking on that higher risk. So it's adverse for them to take on that, higher risks. So that doesn't mean they won't take on high risks, but they've got to be careful about that and it makes perfect sense. Why would they have to be concerned about that and be cautious about it? Let's give some examples. I think that really helps drive home what adverse selection is. In the first example, Don is 65. He knows he has a high risk for cancer in his family, and he doesn't want to leave final expense burden to his family, so he seeks out life insurance. So in Don's case, and this is often the case, this is what adverse selection means. The person knows that they have a higher risk, and that's exactly why they go looking to transfer that risk by securing an insurance policy. So from the client perspective, it makes perfect sense. That's their motivation. Don is motivated because he knows he's got this risk going and he needs to make sure he's covered. So again, that's adverse selection because he's higher risk. Because he's higher risk, he's seeking a policy, and that's what's adverse about it from the insurance company's standpoint. In the second example, Mary is told by her dentist that she will need 3 crowns done fairly soon. So Mary seeks dental insurance. So from Mary's point of view, it makes perfect sense, right? She knows she's going to face these extra costs for dental work that has to be done. So she looks for an insurance company to help cover that risk. But again, from the insurance company's perspective, Mary already knows she's got to do these high cost things. The insurance company knows, wow, we're going to have to help contribute to those costs. That's a higher risk and a higher cost for them. Again, it doesn't mean they won't cover Mary, but they have to take that into consideration when they determine what her premiums are going to be or how soon they're going to cover her and those sort of factors. So it's very important the insurance company knows those risks to be able to handle those risks. In the last example, Brett is diagnosed with diabetes and he does not have health insurance, so he starts shopping for a health plan. Again, from Brett's standpoint, makes perfect sense. He's motivated to go and get health insurance because the doctor just told him, hey, you've got this chronic condition, you're going to really have to take care of yourself. From the insurance company standpoint, that means Brett's going to definitely need care. There's definitely going to be costs the insurance company is going to be helping to pay for. So they have to know that in order to take into consideration how do they set Brett's premiums, what kind of policy can he get, and how can they manage that risk effectively. I hope those examples help you understand what adverse selection means. Now, there are several ways the insurance company manages adverse selection. Now, you don't really have to know this, I don't think, for the exam. They're not going to test you on, how does the insurance company handle adverse selection. But I'm just sharing with you so you kind of have an understanding of why certain provisions are in place in insurance policies, because the insurance policy, the insurance company has to manage this reality of adverse selection. Now, there is often a question on the test about what is the role of insurance agents, that's you, when it comes to managing adverse selection. And the answer is that insurance companies expect insurance agents to collect accurate risk information. In a sense, you're that initial point of contact with a potential client, and it's up to you to relay accurate information to the insurance company so they know what kind of risk that they're taking on. And they do take that role seriously, as should you. You are, in a sense, obligated to report what are those risks that the insurance company is going to be facing. Second way insurance companies help manage adverse selection is by doing medical underwriting when it's permitted. That means they could, in certain situations, collect risk information from healthcare providers. They could look at a person's health history so that they have good information about what sort of risks they're taking on when they decide to cover that individual. They could also create waiting periods, meaning periods of time before they might cover something such as diabetes or that Mary's crowns that she needs. They might create a waiting period so they're able to collect some premium before they're paying out money for those expenses that that person has. Deductibles are also another way of the insurance company, covering its costs and also adjusting the premiums, making those relative in certain situations to what that risk is that they're taking on. So those are at least 5 different ways that insurance companies can help manage this reality of adverse selection. So just to recap, what do you have to remember about this for the exam? Remember, first and foremost, adverse selection means higher risk people seeking insurance. Very simply, that's what it is, in a nutshell. Also, insurance companies need to have a balance of risk in the pool of insured. So that's their goal. And companies are relying on you as insurance agents to gather accurate risk information to help them make valid estimations of what their costs and risks are going to be if they take on a specific client. Insurance companies also use underwriting, deductibles, and premiums as means to manage adverse selection. I hope this has been informative, help you nail all the questions that there may be about adverse selection on the exam. Remember, we have a whole lot of other content. Check us out at lifehealthexamcoach.com so you can have access to all that information and make sure that you pass. So thanks for watching this video, and we'll see you in the next one.